This video is sponsored by Incogni. Ukraine is running out of money. Most European countries have promised to spend at least 3.5% of their GDP on their militaries. And Europe desperately needs an industrial policy if it wants to stay competitive. All of that needs money. Loads of it. The problem? There isn't really much left to go around. Governments are already spending more than they earn, and national debt is hitting new highs. Hello there, France. So, could the solution be EU debt? In other words, what if the EU's 27 countries borrow together? Hello everyone, I'm Lambertus from EU Made Simple, and today we're going to cover how debt actually works, not just borrowing money, but how it functions inside global markets, whether joint EU borrowing could mark a new financial era for Europe, and of course, my opinion at the very end. To explain how debt works, let's look at France, who has been in the news a lot lately because, well, it's rising debt. You see, the French government has huge expenditures. Roads, social programs, defense, and much more. For example, France spent about 1,700 billion euros in 2024. But the French government also earns money, mainly through taxes, but also from things like tariffs, fees, and state-owned companies. And in France's case, that brought in around 1,500 billion euros in 2024. The difference between what a government spends and what it earns is called a deficit. In simple terms, expenditure minus revenue equals deficit. It's like your personal finances. If you spend more than your paycheck, you end up in the red. For France, that deficit in 2024 was about 170 billion euros. That means the government spent more than it received and needs to borrow to cover the gap. And it does this by issuing bonds, essentially government loans. When a bond is issued, investors, from regular citizens to big banks and foreign governments, can buy them. Each bond is a promise. The government commits to repaying the borrowed amount, plus, of course, interest. Now, the key point here is that the price of a bond isn't set by the government, it's set by the market. If investors think a government is stable and fiscally responsible, they're happy to lend at low rates. But if there's political chaos or excessive spending, those very same investors get nervous and want higher interest rates. For years, France's debt to GDP ratio has kept rising, but it didn't seem that alarming because interest rates were falling, reaching nearly 0% by 2020. Now, however, interest rates are climbing again, and debt is rising, and that combination makes the situation far less sustainable. Now, this is a very big problem, and let's take a look at France's total spending by category. This slice is how much France spends just on interest payments for its debt. Doesn't look too bad, right? But you see, normally when the government has to repay those bonds, it just borrows again. No big deal. New debt replaces the old one, and interest rates stay the same. Life goes on. But this time things are a little different. Interest rates have gone up. A lot. So when France borrows again, it'll have to pay more in interest, way more than a few months ago. And in our example, 4 times as much as France had to pay in 2024. And if government revenue does not go up, the deficit will be higher, meaning that the government needs to borrow more to make ends meet. And that, ladies and gentlemen, is what we call a debt spiral. And getting out of one is not easy. You either cut spending or print money. And of course, France cannot print money as only the European Central Bank can. To prevent this kind of spiral, the European Union has rules that set limits on how much countries can borrow. Annual budget deficits should stay below 3% of GDP, and 11 EU countries are already breaking this guideline. And just look at Romania. Quite painful. Total public debt should remain under 60% of GDP, and 13 countries are currently breaking this rule. These fiscal rules are meant to keep member states from overspending and destabilizing the entire Eurozone. But don't get the wrong idea here. Debt itself is not bad. In fact, it's a vital tool for governments. Borrowing allows investment in infrastructure, education, or clean energy, things that drive long-term growth. What matters is how and why the debt is used. Let's go back to France. If France borrows money, but uses it to grow the economy more than it invested, then it's all good. For example, if 300 billion euros gets borrowed for AI innovation and it results in 600 billion euro growth in government revenue, then the debt was completely worth it. It's a return on investment, exactly the same as if someone had borrowed money to start a successful company, for example. Nowadays in Europe, each EU country runs its own bond market. France issues OATs, Germany Bunds, Italy BTPs, and Spain Bonos, borrowing and repaying independently. Richer economies borrow more easily and cheaply, while smaller or less stable ones face higher costs. For example, in 2024, Germany issued about 120 billion euros worth of new debt, compared to Romania's 36 billion euros. Because borrowing happens nationally, funding large EU-wide projects requires complex coordination and negotiation. This can slow innovation down massively. And this brings us to joint debt. What exactly is it to start with? In short, it means the European Union itself, not just France or Germany, issues bonds. The European Commission borrows money from using bonds, just like individual countries. But this time, that debt is backed by the EU budget and guaranteed by all 27 member states. We've already seen this in action before with the Next Generation EU Fund, the massive recovery instrument created after COVID. It's worth around 807 billion euros, spread out between 2021 and 2026. It really was a historic step. For the first time, Europe borrowed together. So, why would Europe even consider issuing joint debt or eurobonds backed by all 27 member states? First, growth. Borrowing collectively means bigger funding pools for businesses, startups, and green or digital projects that cross borders. It makes large-scale investments like new rail networks or renewable grids faster and more efficient. And then there's interest rates. Joint European debt would be much more attractive and safe than individual states' debt, and so it would have lower interest payments. It also boosts the euro's global appeal. With a deep liquid euro bond market, investors could see the euro as a stronger alternative to the US dollar, especially as confidence in the dollar assets shift. And there's political upside too. Joint debt ties Europe closer together. When member states co-finance projects, it builds trust and shared responsibility. But of course, as with all things, it's not without risk. Joint debt can open the door to fiscal irresponsibility. If some countries spend too freely, others end up sharing the bill. It also blurs accountability. When everyone's responsible, no one fully is. Wealthier nations might worry they're subsidizing weaker ones, while others fear losing control over their budgets. And if not managed carefully, it could also spark political tension between countries. That being said, what's standing in the way of joint European debt? The primary hurdle is the requirement for unanimous approval from all 27 EU member states. This means that every single country can block the proposal, leading to a deadlock. And this is already happening, as Finland has recently opposed expanding joint EU debt, even threatening to veto the proposal alone. Additionally, some nations are wary of increased borrowing, fearing that it could undermine fiscal discipline. Germany, Sweden, and the Netherlands have expressed concerns about exactly this. And the opinion of the other EU countries vary, but these three countries are definitely the most vocal. This is what I think. Joint debt can be a super powerful tool for the European Union, and it should be used, but carefully. There are some areas where it absolutely makes sense, especially the three we mentioned at the start of the video. It's in everyone's interest to fund Ukraine. It's in everyone's interest to finance our collective defense. And when it comes to competing with China and the United States, Europe also needs to invest together so that we are stronger. Put it this way. In the last quarter, Microsoft alone spent 35 billion euros on capital investments, mostly in AI. Germany plans to spend 18 billion euros over 4 years across all future technologies. The difference is kind of sad, really. And while it's not fair to compare a government to a tech giant, it does show the scale of what we're up against. If we want to build European technology, we're better off at working together. But there are also big no-go zones. The EU should not borrow money to bail out countries that have overspent, or to cover national pension systems. That needs to stay strictly separate. In the long run, though, what would be even better than joint debt is giving the EU its own financial resources. If Europe could raise money directly, like collecting taxes from big tech, earning returns from EU-wide investments, or even generating revenue from reciprocal tariffs, it would be more independent and stronger to pursue such policies. But let me know whether you think the EU should borrow together or not. And this brings us to our sponsor. A few months ago, I got a call from a random German number. It looked legit. The guy claimed to be an Amazon representative, asking whether I wanted to extend or cancel my Prime subscription. Perfect timing, I thought. I barely use Prime anyway. So yeah, you're probably calling me an idiot already, and you'd be right. My brain was deep in the middle of writing a YouTube script and I wasn't thinking. He sounded super professional and said all I had to do was download a service app from the Play Store. So I searched it and I actually found one. But thank God, Just before hitting install, my brain finally switched back on screaming scam. I cancelled the call, and after a bit of Googling, it turns out the app would have helped to compromise everything on my phone, including my banking details. And this wasn't the first time. Scam calls, phishing emails, sketchy links, they keep coming. Why? Because my personal data is out there, and yours is too. Available to scammers, data brokers, and anyone willing to pay. And for a long time, there was literally nothing you could do about it. Until now. Check out Incogni, a service that fights to get your personal information removed from data brokers. These companies are legally required to delete your data if you ask them. But doing all of that manually, that's pretty much a full-time job. And Incogni does it all for you automatically. They contact the brokers, request removals, and handle any objections, all on your behalf. It's super simple, really. Make an account, tell them what info you want removed, and give them permission to act for you. Then just sit back and let Incogni do the work. So if you want to take back control of your data, click the link below or go to incogni.com/EUMadeSimple to sign up and get an exclusive 60% off an annual plan. Thank you so much for watching, and thank you to our presidents, Jan Schalke, Christian Peter, HVD, Daniel Unite Europe, Stefan, and Kiki Loxen. See you in the next video.